The Bank of Canada is due to make its latest interest rate decision on Wednesday, May the 25th. This could have a significant influence on trading in Canadian markets. The Canadian stock market has actually been in recovery mode since the beginning of this year. We've saw the large cap stocks bottom out in January, February, and they've been steadily trending higher since. The hammer candles here and here in an island base show that we've had a significant reversal with the bears being exhausted, and we've had a steady recovery. This steady recovery has also been in tandem with energy stocks and with energy prices. A lot of what had dragged on the Canadian economy and sparked the Bank of Canada's two previous rate cuts were the struggles of the oil patch. When the oil price crashed, the Bank of Canada took steps to try and prop up the economy, knocking rates back from 1% to 0.5%. Would the Bank of Canada go any lower? Probably not under normal circumstances. I don't think they're going to cut rates. The only reason I could see them cutting rates is if the bank feels that the economy needs a boost to recover from the Fort McMurray wildfires. We'll recall that the wildfires in northern Alberta have shut in over 1 million barrels a day of oil sands production, plus they've essentially shut down the city of Fort McMurray, forcing about 90,000 people to evacuate to the south. So that is it's a huge natural disaster in northern Alberta. This could have an impact short term on the economy. Will the Bank of Canada take a short term step to try and help the economy work through this disaster or not remains to be seen. But if they do cut, that is the only reason I think they would actually do it, and it would be a short-term thing to help the Alberta economy get back up on its feet. In terms of where we're going, we've got the Canada 60 bumping up against 825 resistance here, and if we go back and we look at the Canadian dollar. I'll start with CAD US dollar to show that just like Canadian stocks, the loonie has been steadily recovering as well. Now, it had a really good run up off the bottom, got up to 80 cents. It slipped back to 76 with 75 in sight. This is after it got quite overbought. This is what we would call a fairly normal trading correction. This momentum looks like it's leveling off here. The next thing I'll just highlight briefly is dollar CAD. And in the case of dollar CAD as well, we've had a big decline in the U.S. dollar relative to Canadian. CAD's been recovering with the oil price, even with the Fed heading towards the possibility of a rate hike. Yes, we've seen a bit of a bump up, but it hasn't been huge. If I just bring this up and make it a little bit bigger here, this latest bump has been more due to the Fed pricing in a Fed potential June rate hike. A lot of the decline previous to this was related more to, so we had this big decline here from the beginning of the year on down. This has been tracking the rally in the oil price. As we can see, we got a little quite overextended down here, little overextended up here. So we could still see some activity, though. If we did see the Bank of Canada deliver a surprise rate cut, then you could see the Canadian dollar get knocked lower on that kind of a development. Otherwise, you might see the Canadian dollar continue to rebound, but that also can be influenced on what the price of oil does.